Now let's get to the really interesting stuff, which is non-agency deep discount bonds. Okay. We got about 5 minutes left to go through this last example here. Okay. So I'm going to go through this last example. This was issued 199 months ago. These loans are 17 years old. The underlying loans, and let's get down to the underlying loan characteristics. This is a $27 bond. Okay. The underlying loans are paying a 5% coupon. These are fixed rate loans, but this is a floating rate security. Okay. The underlying loans are only about 12% delinquent. The underlying loans have an LTV of 51. And that's just on an amortized basis. When we look at on an underlying basis, what they're with home price appreciation, these borrowers have more than 60% equity in their home. Okay. Let's look at what these borrowers have prepaid historically. So when we look back to pre-COVID, which is right here, you're looking at 7 to 8% annualized prepayments. Okay. About a 2% delinquent. When these loans do default, when there's a CDR default, you're actually getting back about 75% of your money. So you don't care if these borrowers default or prepay. Post-COVID, rates dropped. Prepayments went up to 20% per year. Okay. Again, we own this at $28. Every prepayment is a 72-point profit. Okay. Now prepayments have dropped back down to about 5. Okay. So this is going to be a little bit hard to see for folks, but we model this in Intex. Intex is the gold standard for modeling all of these bonds. When we run this bond here, to forward curve, again, for a floating rate bond, you don't want rates to drop. You want rates to stay the same or go up even further. Okay. If nobody ever prepays again, 0 CPR, 0 defaults, this is almost a 7% yield. Okay. This bond has a duration of -16 there, meaning if rates go up 1%, the value of this bond goes up 16%. Okay. To where it's paying right now, 5 CPR, to the forward curve, it's an 8% yield. To go back to what it was paying, 15 to 20, you're looking at a 15 to 30% annualized yield. If the deal were to get called tomorrow, you double your money, a 648% yield. So what if rates stay static? What if rates stay up here? Because this bond is spitting out a 5.5% coupon at 22 cents on the dollar. It's spitting out 15 points a year just in interest. It's also paying principal. You know, this bond's paying on average $62,000 a month in principal, plus $150,000 a month in interest. But wait, like I said, if rates were to stay the same, you go from an 8% base case yield. This is to the spot curve using the same scenarios. You go from an 8% yield to almost a 15% yield. So I went over that agency bond where you went from a 5% yield to a 6.5% yield. That's a $97 bond. Every prepayment is a 3-point capital gain. Here, this is a $28 bond. Okay. You go from an 8% yield to a 15% yield. Now, if rates actually do drop, like that curve is forecasting, guess what? These borrowers are going to prepay at a faster rate. They're going to go back to that 15 CPR potentially. So here's your upside to the spot. But realistically, if rates drop commensurate with that curve and your coupon goes down, well, guess what? Your CPRs are going to go up. They're going to go back up to 15 potentially, which is another 15% yield.